Yes.
Did y'all hear that? Recording in progress?
Yep.
All
It
right.
says on my screen as well.
All right. Okay, I have started it. And people, all right, we have people entering in now. All right, for everyone that's coming in, Joe, we usually start right at 6:30. What time do you have?
I've got 6:29 still.
Okay.
So we got a little minute. Yeah, people are starting to trickle in. And you know, I sent it all to my list, Craig, as you know, and I say we had an okay RSVP. We also sent the link, Craig, to all of our clients today, just in case you know, some people missed it and they didn't necessarily RSVP.
All right.
I'd say we wait, Craig, till we hit 6:31.
Okay.
See what we've got. There we go, Craig. We're at 6:31. So your call if you want to crank it up.
Yep. You can you go ahead and start, Judd.
All right, good deal. Good evening, everyone. My name is Judson G, certified estate planner, managing partner of JHG Financial. I'm excited about the 6th webinar that Craig and I have put together. He has done some on his own as well. And we'll talk a little bit about the fact that he's got links on his website, as well as I have podcasts on mine. We're going to actually talk about some alternative products tonight, but definitely all about real estate investing and tax mitigation, I think, tonight. So a couple of things that I have to do, of course, is introduce Craig Lancaster, my personal CPA, genius tax preparer CPA. Got so lucky, and I think if he's your CPA, then you're lucky as hell too. He is an amazing partner to have. And if you work with both of us, you got a fantastic 1-2 punch. Believe it or not, folks, not a lot of people's financial advisor and CPAs work together in unison. So I am very lucky to have Craig as my personal CPA. And of course, I have to put up my disclosures for my firm. This is for educational purposes only, and it is not a recommendation to buy or sell. Past performance may not be indicative of future results. I also always like to start out with a quote. My grandmother had one, and she said she liked to make money while she slept. And I don't know if Warren Buffett, she would probably be older than Warren, but nevertheless, he had a really great one that I like a lot, and it does have to do with what we're talking about today. And that is, if you don't find a way to make money while you sleep, you will work until you die. So Craig, I am going to go ahead and turn it over to you and stop sharing, I guess, at this point, and let you do your thing. And then we'll introduce Tim Cronick with Capital Square in a little bit.
All righty. Welcome, everyone. As Judd said, this is our 6th webinar together, and this one's a little unique, I think, Judd, because we're gonna kind of talk about all facets of real estate. I'm going to basically talk about the entity structure and the tax implications, whether you're flipping or building, whether you're renting, land and just land investing. We're going to touch a little bit on 1031s, REITs, and OZs, but I'm really going to save that all that for the expert Tim, which we're really lucky to have from Capital Square. He's going to really touch on those quite a bit. So I'm just going to kind of go over those pretty quickly and let the expert speak. But I did want to start out with the flipping and building. I do have clients that flip houses. I have some clients that start from ground up and they build. And they ask me all the time, what type of structure should I have? Well, with the flipping and building, most of my clients are an LLC. They do that for legal purposes. I am not an attorney. I cannot tell you all the legal reasons why you should, but the LLC will allow us to do some tax strategy, such as turn you into an S corporation. I do believe that if you're in business to flip or build, you should be an LLC, mainly for the tax reason, but there are some legal reasons we can talk about. Now, I put bookkeeping and record keeping in here because, unfortunately, some of my clients know how to build a house, Judd, but they don't keep records. So you've got to keep your expenses. We've got to know what you're spending. You come in my office, I can't have you looking up in the corner to find the number. It's not in the corner of my office. So I really need you to use Excel or QuickBooks, anything that will help you keep it. I don't care if you use a trash bag. Put the receipts in a trash bag and bring it to me. That way we can at least come up with expenses and prove it if we need to. Now, if you're a flipper or a builder, the problem is, not a problem, but this is not passive income. The tax implications are this. If you're a sole proprietor or sole member LLC and you do not elect S Corp election, your flipping or building projects will be reported on a Schedule C, and it is subject to self-employment tax. And self-employment tax is Social Security and Medicare, but you get to pay both sides, the employer and the employee side. That's 15.3%. Doesn't include your normal federal income tax or state income tax. So as you can see, it can get quite expensive. Partnership. Well, to be a partnership, you got to have two or more. You can't be a partner with yourself. There is possible self-employment tax on a partnership if you're considered a general partner. The S corporation, what it looks to do is eliminate self-employment tax. Now, that is a very generalized statement because you are supposed to take a W-2, but I want you to know those are the three schedules or three tax implications that you have. Most of my people are LLCs taxed as S corps. Now, a lot of people want to know, should you depreciate? If you were building a house or flipping a house, it is considered inventory. You cannot depreciate it and take it off 1 year. It's just inventory that you have. The sale of your property does not constitute capital gains. It is taxed as ordinary income. So what I hear people all the time, they're trying to build a house and they want it to be long-term capital gains. If your intent and your job is to basically build from ground up or flip, then it is a business. Also, I have a lot of people that build these houses and they want to do a 1031. You cannot do a 1031 on a build. Again, you're a builder. Now, I do have some builders that will actually build a house, make it a rental. They do that so they can get a 1031. Little gray area is how long does it have to be a rental? If someone's interested in that gray area, please speak to me. Each example could be a little different, but I do have a few people that build just to make it a rental so they can sell it anywhere from year 1 to year 2. But I did want to bring up flipping and building because I do have clients that do this. The biggest one I have, renting. I would tell you quarter, Judd, probably 25%, Tim, of my clients have rentals. And they obviously want to know how they should be set up. Once again, LLC is where I typically push people to go. Now, rental is a little different. The bookkeeping, the record keeping, still the same. You need to keep up with your books and your record keeping, but the tax implication is slightly different. And what I mean by that is most rentals are reported on a Schedule E, and it could be subject to passive activity losses unless you're a real estate professional. And, there's general guidelines of a 750 hours or so forth, but we can talk individually whether or not you qualify for real estate professional status. But as far as the rental goes, I would tell you 95% of my people report on Schedule E. I do have a couple, including myself, that I do report. My wife and I, we report on a partnership. It's not necessary. And there are just a few benefits. If anybody would like to discuss those benefits, please give my office a call. I'll be glad to go over that with you. S corporations, I don't have anybody I don't have many at all with S corporations that I recommend. Number one, there's no SE tax on this rental because it is considered passive activity. And number two, North Carolina charges a franchise tax on your assets. So if you got $3 million worth of rentals, North Carolina's got their hand out for an extra franchise tax that you just don't need to pay. Depreciation, that's a big thing with rentals. Residential depreciation is over 27 and a half years. Commercial, most of the commercials are 39 years. So yes, you don't get to take it all off the first year. If you buy a house for $275,000, you're going to basically depreciate $10,000 a year over 27 and a half years. I did want to touch briefly on cost segregation because a couple people have asked about it. Cost segregation, which Tim's probably going to get into a lot more than me, possibly. Cost seg is when you first, typically it's when you first buy a property. It can actually be after you bought the property, but most people do it when they first buy the property. They'll have a third party go in and analyze each asset class. And the reason they're doing that is if they can break down 5-year assets, 7-year assets, 15-year assets, instead of depreciating that over 27 and a half years or 39 years for commercial, they get to take it all in year one. It's very, very aggressive depreciation. So that is a good thing. But once again, be careful of the passive activity loss rules if you make over $150,000, unless you're a real estate professional. Once again, anybody has questions about cost seg, just give my office a call. The one thing I do always have a problem with is the sale of rental property. There's something called recapture of the depreciation, and yes, it's let the crime begin, because too many times clients will go sell a rental property and they don't ask me. And then when they sit in front of me and I tell them that I've told one person they owed $128,000, they cried. And it's because you took this depreciation, the government gave you depreciation for as long as it's been a rental. If it's been a rental for 20 years, you've really depreciated that property and got to take it off your ordinary income for years. Well, guess what? When you make the money back and you make a gain on it, they want to jack the prices up. It's not no 15%. So you got to be very careful. If you ever sell a rental property, do not sell a rental property till you run a tax planner. You need to know. Now, Tim is going to touch on ways for you not to pay $128,000, but there are 1031 exchanges, which a 1031 exchange is basically you're going to exchange for another like kind property. It's got to be a real property since 2018, but you can also exchange into, you don't have to go for house to house. You can go house to, you actually go from a house to a commercial. You can go from a house to a DST. And again, Tim was going to get into all that. And We are going to touch briefly on OZ funds, but Tim's got a whole section for OZ funds, so I am going to move on with that. I do want to give you a little quiz, just so you can see about rentals. Jake bought a house on January 1st, 1992 for 150 grand. He placed it immediately as a rental. Over the years, Jake made improvements to his rental that cost $50,000. So Jake's put $200,000 in this rental. On January 1st, 2021, Jake sold his rental home for 400 grand. Over the years, he had taken depreciation of 130,000, making his net basis in the property 70 grand. So he put in 200. Over the course of all those years, he wrote off $130,000. And so his basis in the property is 70 grand. His marginal tax rate in 2021 was 32%. His state tax rate was 5%. His long-term capital gains tax rate is 15%. So what do you think the gain that will be reported on Form 4797 when he files his return? And how much do you think Jake's going to owe? So I'm going to really quick just show you it's the same problem. He had a sales price of 400,000. He has to minus the 70,000. The 70,000 is his basis. The 200,000 that he's put in minus the 130 he's taken off over the years. So he has $330,000 of long-term capital gain. But remember, the government's saying, hold on. Part of that is what they call Section 1250. They're going to say, hold on, you got to take that depreciation off at a higher rate. You don't get the whole 330,000 taxed at 15%. No, we want the first 130 at 25%, and we'll take the remainder 200,000 of your 330,000 capital gain at 15, and then the state's got their hand out for 5. So in Jake's mind, he's upset because he gave $200,000, he got $400,000, and the man thinks he only made $200,000 profit. Well, the government's taken $79,000 of his money. And it could have been worse. Jake wasn't in the highest tax bracket, but this is where he's sitting. So obviously you can tell, I want to make sure that if you sell a rental, do not sign a contract without running a tax planner. Let's talk about land investment real quick. Land investing, it's all about the intent of the land is key. If you bought a land for personal reasons, maybe you bought it for a second home and it never happened. Maybe you bought the land to a rental or to build or for land speculation. That's very key to find out why you did it. Now, if you bought it for a second home, there is really no entity setup. You don't really need any legal protection from yourself. However, if you really bought it and you're going to build something or land spec, if you're going to have anything with business, I would set up an LLC. Again, that makes it look more like a business. Bookkeeping and record keeping is not much on land, so that's pretty easy. Tax implications. I've had people try to tell me that you can depreciate land. You cannot depreciate land. Cannot do it. Typically, there's no tax issues until you sell or convert it to a rental. Gains and losses are usually reported on Schedule D of your personal return. Keep in mind, you cannot take a loss for a second property. So if you bought land, you were going to put a house on it as a second home, and you decided, you know what, my wife don't want to live there no more, doesn't want to have a second home there, and you sell the property at a loss, you cannot take it off your tax return. However, once again, if it was investing land, you could do a 1031 and get out of it, or if you have a capital gain, a long-term capital gain, Tim's going to tell you what you can do with an OZ fund. So really quick, the next few slides are what Tim's going to talk about, so I don't want to spend too much time on it. A 1031 is just deferring capital gains by selling one property that was for business or investment purposes and buying a new one for the same purpose. Must be a like-kind property, but once again, you own a house, you own a rental house, you can switch it for an apartment complex, or you can switch it into a DST. Proceeds should be held by a third party. Judd mentioned a QI. You've got to be careful when you're selling these houses. If you touch the money, you're going to get taxed. In the story. So currently, there's no limit how many times you can do a 1031. The good news is, well, bad news, but when you die, your heirs get a stepped up basis in the cost, making this one of the best ways you can move wealth to the next generation tax free. This has been on the chopping block for some time, but I'll be honest, I think the people in Congress, they do so many 1031s, I just don't see it going away. But you always hear it's up to go away, but it just never does. Real quick, before we turn it over to Tim, I do want to mention REITs. Real estate investment trusts, is it a good investment? A lot of them, not all of them, have mailbox money without management. It means you don't have to do anything but go to the mailbox and pick your money up. Typically, they're a limited term, 3 years, 5 years, 7 years. Tim will get into that some. Disadvantage, your money is locked up. That is a disadvantage. You just can't run on down there and say, hey, I want my 50 grand back. Entity setup, you don't need to have an entity. You don't need to be an LLC to own a REIT. Tax implications, you're going to receive a K1. That will go through on your personal return. Again, there are tax deferments, the 1031 exchange. I don't know if Tim's going to talk about UPREITs, but I know that his company does those, I believe. And he also got OZ. Real quick on OZ. These are opportunity zones that came out in 2018, and it's for economically distressed communities. So if you decide that you don't want to pay capital gains, let's say you had a $50,000 capital gain, you can invest in one of these opportunity zones.
And that can be a stock, stock or anything that produces a capital gain. It does not have to be real estate.
Just needs to be long-term. It can be a stock. Judd is correct. So you invest and you get to defer these capital gains. Now, there is new legislation pending to go out to 2028. Hopefully we can get the stepped up basis, which people got back in 18, 19, and 20. Any gains, here's the main thing. I tell my clients this, any gains that you get after 10 years, you do not have to pay tax on that particular gain. So this is like a Roth IRA on steroids. If you're not willing to lock your money up for 10 years, do not do this product. And I think I've taken more of my allotted time. So Judd, you want to get the expert going?
Absolutely. So the first thing I want to do is share with our attendees the fact that, I've got a podcast. I do these every time we do a new one. They're called Financial Fitness with JHG. I like to work out. And if you're old like me, you remember JFG Coffee. That's kind of why I made it JHG Financial. But the best part of your day was their slogan. These are anywhere from 10 to 20 minutes long. We talked about this one, episode 8, alternative asset classes. That's what we're talking about today, 1031 DSTs and opportunity zones. Last time we did a webinar, we also talked about alternatives. So jhgfinancial.com, go to the podcast. Craig also has his website, and on there are the webinars. We don't quite have the one up from last time, but we do have all the other ones that he's done.
That's my fault, Judd. I will get it up this week.
That is okay. That is all right, brother. I am going to introduce now our next presenter, which is Tim Cronick, Regional Vice President, Southeast Sales with Capital Square. Tim brings more than 18 plus years experience in real estate. And I didn't know this until recently. He actually has his JD. He is an attorney as well, specifically kind of in the real estate component. He's lectured throughout the U.S. on Section 1031 exchanges, real estate, written in widely in real estate. And prior to joining Capital Square back, I think in 2019 or 2020, he was also with SmartStop, which actually is a kind of a REIT in the self-storage, which I love that area. So before I turn it over to you, I did want to run one more thing, and that is Craig and I actually went up to Richmond, where Capital Square is at. We did a 24-hour turnaround trip on Friday, and we went and visited their most recent 1031 DST. It is called the Otis. I'm going to run a quick video here if we can get this up, and I'm going to put it on full screen. Folks, this property, you could plop it down on the Miracle Mile in Chicago. It's got a ton of common area, including these two that you just saw. Big pool. I mean, it's so thoughtful where it's the murals on the outside, the fact there's a coffee shop connected to the building, this club room, phenomenal. There's beer taps in there. There's a pool table that's phenomenal. There's actually a dog park on the second or third floor. Vossen Brewery right across the street from it. And this is a gym. I would live in here just to work out in this gym right here. I get 4 days in a week myself. Look at all the places for the bikes. It's got chargers for electric cars. Again, I would camp out in the mailroom, Tim. You know, this is one of their 2 bedrooms. We visited this. I mean, it's just amazing the finishes that they put in this place. The closets, my wife would love it. They're huge. And they were pretty economical when you think about Richmond, I guess, maybe versus Charlotte. But I just wanted to kind of run this real quick because I think the product that they're building is absolutely phenomenal. And after remodeling an 1893 building myself with my partner and friend up in Tennessee, it kind of puts it to shame. But nevertheless, I did want to run that real quick. And Tim, I am going to switch it over to you, sir, and I'm going to pull up this, and you just tell me when to change the slide, sir.
Okay. Hey, well, anyway, guys, thanks for having me. I do love that building you were just in. I remember it was being built from the ground up, and I thought, what is this going to look like? And it came out to be almost a masterpiece. I tell you what, Craig has done a pretty phenomenal job with 1031s. So let's skip. Oh, I think I can save us some time. Let's sit here for just a second. And then I'm going to add to this a little bit. And if anybody wants any of the slides or the material that Judd has, at least for Capital Square, I can get it to you so you can sort of marinate on it. But this slide's important because, you know, Craig touched on some of the minutia that comes with doing a 1031. It has to be like kind. But here's the thing about like kind. It doesn't have to be the same asset class. It can be farmland for office, for apartments. And so what I thought I might do is take that middle section and just give you guys some extra reasons on why to actually do a 1031, because you would be surprised. It's not just for deferring tax, although that is the big reason, of course. But a lot of people will do 1031s if they want to diversify. Maybe they have all of their eggs in one basket, and whether they use a DST or a Delaware statutory trust, and I'll jump in there in a second, but just bear with me, whether they use one DST or several DSTs or several properties or whatever, you can take, you know, one property where you might think, oh, you know what, I've got all of my eggs in one basket, and you can go diversify in multiple properties and lower your risk to a certain degree. And I also see a lot of people doing the exact opposite. They've got 50 properties spread out around the country, and they'll sell the 50 in chunks, maybe chunks of 10 or 15 or whatever, maybe even 5. and then take that money and consolidate it into, say, 50 properties, bring it down to 5 or 10, because 50 properties can be quite the headache. Geography is a big one, Judd. You say you're living in California, everybody's flooding from California to Tennessee, right?
Yes.
You will see a lot of people doing 1031s. And they'll do it for geographical reasons. Deferring tax is easy. You know, Craig touched on this a little bit, but a lot of times you may own a building somewhere and you fully depreciated it. Well, what you can do then is 1031 into another property, put some leverage on there, and restart the depreciation clock to a certain degree. Your basis will still transfer over, but you can still do that to gain some losses and move carry forwards. Changing asset classes, big one. A lot of people running from office and retail into apartments like you just saw, although that was an opportunity zone. You know, they'll get a little older, and what we'll find is our older people don't like debt. So, and when they classify debt, they mean recourse debt, something that may, if things go south, that they could be responsible for. At least in a DST, all of that debt is non-recourse. And so we can get better debt, better rates. You can switch to passive management from active management. And of course, if you're continually doing 1031s, it becomes part of your estate plan. And the term, although a little bit crude, is swap till you drop, which means you keep swapping and doing 1031s. Hopefully you'll find some professionally management stuff, because most people get to a certain age and they don't like dealing with tenants and toilets and trash and all that. And they'll swap into a more professionally managed building where they don't have to deal with all that. And so I just wanted to kind of hover on that middle section. But, you know, I've mentioned DSTs a couple of times now. Let's switch to that second page, Judd, so we can kind of flesh out what a DST is. A DST stands for Delaware Statutory Trust. And I wanted to do this second so that everyone on the call could realize all of that stuff can be done on their own. They can trade properties, they can go from different geography, they can consolidate and diversify, and they can go find their own properties. This is not a sales pitch. It's just something they can do. However, if they don't want to deal with all the headaches and so forth, what you have is what is called a Delaware Statutory Trust. Most people will say, if they've been in this industry for any length of time, they're going to say, well, a trust isn't qualified for 1031. This one is. If they want to look it up, they can go to Revenue Ruling 2004-86, and there are the rules set forth for a Delaware Statutory Trust, which is indeed qualified for 1031. We love them. They're easy. They're malleable. We can take a DST and we can help people diversify. A lot of people would call that a diversified DST portfolio, where, let's just say, somebody's dad owned a warehouse somewhere. And you know what? He wants to leave it to the kids. The kids don't want it for whatever reason. We can trade into a DST or several DSTs, diversify them out, and lower their risk, and then the cash flow is automatic. You know, the growth is very reasonable, and it comes with other types of benefits that comes with a trust. So you do get the asset protection, like it says there. You do get confidentiality. They are more flexible, but going back to the original topic, they do work well with tax deferral. They are passive income. And we mentioned tenants, toilets, and trash, but that is a big concern for most of our investors. The passive management is a big deal. You'll get depreciation. It'll be based also on the non-recourse debt that comes along with the replacement property. And so to kind of wrap this up in a nutshell, you sell your what's called a relinquished property, or whatever property you're going to sell and realize your capital gain on. You've got 45 days to identify. You've got 180 days to close. Craig's already told you guys you can't touch the money. That's called constructive receipt. That is a problem. You will pay taxes if that occurs. But when you guys are sort of looking at the landscape of selling your property, a big concern is, well, gee whiz, I don't want to have to sell it, pay taxes, go find the real estate, do it all within 45 days, stick to the rules of Code Section 1031, and then restart the engine. Where, Judd, as you know, you can sell the property. The QI will be taken care of initially. All the paperwork is done. They will coordinate with your closing attorney. The funds will go immediately into the QI, and then if you're prepared, if they're clients with Craig and you, I'm sure they will be prepared. Then you'll have what is the term? I don't want to use the term buffet, but you'll be able to tailor a program that will fit whatever they're worried about or whatever concerns they have, whatever yield they need, whatever time frame they're on. And generally speaking, as far as Capital Square is concerned, if they traded into one of our Delaware statutory trusts, you know, we have a pretty great track record. I would tell you guys to consider the fact that it'll be a 4.5-year hold. Have they been shorter than that? Absolutely. But generally speaking, if they trade into one of our apartment complexes, there'll be a 4.5-year hold. And the overall returns are double digit on an annual basis. Now, we specialize in apartments. There are plenty of other companies that do other things, but we like apartments in the Southeast. Why is that? Well, owning housing in a housing crisis is usually never a bad thing. So what I'm trying to say is, you're not going to let, or Craig's probably not going to let the tax tail wag the dog here. The real estate is still always going to be about the real estate, and you need to find good real estate. So fundamentally, we're going to want low supply, high demand. And therefore, we're in apartments. We're in apartments in the Southeast. And what you all know is, if you've lived, especially in North Carolina and anywhere around the Southeast, is there's a housing crisis, number one. And then there's also what you would call the Great American Migration. So we like the housing crisis when we own apartments, but we're front running a lot of migration that's occurring. So that stacks the deck in our favor. And what I failed to mention previously is you still have 10,000 baby boomers retiring a day, and a vast majority of those, or at least a majority, are downsizing. And a lot of them you'll find be moving into apartments or fancy places like you showed earlier, which is an opportunity zone in Scott's Addition.
Tim, I have a question
Let me stop
for you.
there. Let me stop there and deal with any questions we got.
I've got a question for you. Can someone, up here, if you look at the rules, you've got to identify a property, 45 days, and you've got to, close on it in 180 days. You've got to have a QI, a qualified intermediary, which doesn't cost much, but it does cost something. Can you choose, or should you choose, multiple properties or multiple DSTs? Or can you even add an OZ, which we're going to talk about, into that mix as well?
Yeah, absolutely. And I guess it depends on every individual. And I'm sure that's something they'll discuss with you, Judd or Craig. But we frequently will take one large property. Someone will sell one of their properties. It'll be a large one. and their goal, they're getting a little older, is risk management, and they'll want to diversify. And that's one way to do it. And the great thing about it, it gives them, although it is passive investing, and they get all the benefits that come with passive investing, the depreciation, potentially the cost segregation study, and all that, you're still getting income on a monthly basis. And it's arriving to your mail. What did you call it the other day? Mailbox money. It arrives on a monthly basis. And it's a good return. It happens every month. And then we're looking to grow this thing as well. I didn't mention the overall returns because they are in excess of 10%. And I don't know if that's something I should say on this line. But we conservatively underwrite these things with growth rates at 3%.
Well, Tim,
yeah.
What I want you to do is do me a favor. I'm going to give you an example of a hypothetical.
Okay.
Let's go back to Jake. Jake sold that house for $400,000. He decided, he told me, Tim, he's done. He's done dealing with damn tenants, and he don't want to worry about the toilets. And he puts it into a DST with Cap Square. Can you hypothetically, I know past results are not indicative of the future, but can you apply that example to a past DST historical data and let my clients know, hey, 400,000, Jake put 400,000 into a DST 7 years ago. The runway is about 5 years, and how the mailbox money works, because that's what they want to know.
Sure. Well, yes. I think there's two steps to this. The first step is, how much money are they investing? Because in your example, they only had 300. They only had like 320 grand, right?
What's that?
I said, step one is, how much are they investing? Because if they did not do a 1031, they only have 321,000 left, right?
That is correct. But he's doing the DST for 400.
Okay, good. So that in itself, though, if they did the math just on the fact that they're investing with leftovers, that's a big issue. But let's just say Jake's a pretty smart guy. He's sophisticated. He takes all 400 and he rolls into a DST or one of our DSTs. I'll just tell you this because I know it's compliance approved. Our track record since inception on apartments is a 14.22% internal rate of return per annum, which is big. What I tell everybody, especially nowadays, interest rates are higher, and so forth. Be happy with 10 to 12. But that's a conversation for Judd later on down the road. But we frequently buy properties that we can add value to. And I'm not talking about buying C and D properties. I'm talking about buying properties that are coming out of certificate of occupancy where the builder needs to move, and maybe it's 75% occupied, and we'll run that up to 95% occupied. And then we get to capture that growth for our investors. And as you know, and your investors probably know, your overall purchase price or sales price is going to be based on net operating income, or income derived from the real estate, and they'll put a value on that income. And so for us, our job is to raise cash flow. Cash flow goes up, your property values go up. And we hope to sell that within 4.5 years. And then you're going to have to come back to Judd and Craig and make a decision. Do we do another one? Or do we go to Vegas? Or whatever we're going to do. Most sophisticated folks will do like I said earlier. They'll plop it into their estate plan. It's in their real estate bucket. And they'll keep doing 1031s until they pass away. And then their heirs will get a step up in basis. And then all their taxes are washed away.
On that 14% IRR overall, what of that normally, so because they do change, is coming in from income? Is that 4, 5, 6% kind of year mailbox money, or what?
Yeah, so let me just tell you what we have currently. I think it'll be a better example. Okay. So currently we have 2 apartments that are paying out about 5% a year in cash flow. But that you may not do cartwheels for that 5%. You may not be excited by that. But Craig, what happens when we factor in depreciation?
Well, when we factor in the depreciation and they get to write that off, some of my clients are in the 32, 35, 37% bracket. You know, if your depreciation on the cost seg and you have bonus depreciation and 1 year you get 80,000 worth of depreciation at, 37%, do the math. That's a humongous tax savings for some of my clients. And we're talking, especially that first year, upwards of 20, 30,000 bucks on that type of money.
Yeah, so your 5% is tax free, so that's probably a tax affected, I don't know, 7.5, 8. Then you lock those losses in with the cost seg study. So now we can, most of our investors, not all, but I would be remiss if I didn't bring this up. Most of our investors, they're already in real estate. If they're doing a 1031, they generally have other sources of passive income. And so we can take the leftover losses that wasn't wiped out on the 5% cash flow they're deriving from the real estate and take that and offset other passive income. So you'll really get a really large effect just from looking at the DST, being happy that it's conservative and reasonable and low risk. And then you're going to get your 5%, but we're going to get the losses to offset that. So that'll juice your cash flow, and then we can offset some other passive income. And in 4.5 years, we're going to sell it.
And real quick, Tim, before we get into OZs,
yeah,
Jake's 75 years old, and I want you to, briefly for a minute, Jake has come to you and said, Tim, I'm tired of swapping till I drop. I need you to take 1 minute and talk about 721.
Okay. So 721 in Jake's example is probably at least a logical idea. Judd and you will have to decide if it's a good idea, but logically, if he's 75, then he wants as much safety as possible. And when you do a 721, really kind of think of it in terms of a 1031, but there's no cash that changes hands. Instead of somebody giving you cash for your property, they're going to give you stock in the real estate investment trust. And that's not a taxable event. So you're taking your building that you may have all your eggs in one basket in, you're trading it for stock. It's not a taxable event, but now you own a piece of, let's just say, 25 apartments instead of just one. So the benefits are it's easy to diversify it. The cash flow is a little bit more stable, maybe a little higher because you have economies of scale. And then it's also divisible because since Jake is 75, and let's just say he's got 7 kids, now we can give each kid stock in the REIT rather than have to worry about tenant common interest or fractional ownership interest in a DST.
Okay. Thank you. There's a couple people that would be interest to them.
Yeah, no problem. How much time do we have, guys?
We're good. We might run a little bit long. Sorry, folks, but I think this is really informative. And so real quick, Tim, before I turn it back over to you, I sold my office building. A lot of y'all know that in October. Had it for 16 years. I think the internal rate of return was somewhere around 5%. And I thought I had historical tax credits because of our building in Tennessee. Well, we did not. We didn't know that till the last minute, did we, Craig?
No, not to the last minute.
And so I had to jump into something where I'd already sold the property. And so opportunity zone is one of the things that I use. And so I like to drink my Kool-Aid, and I am in Capital Square. I'm in opportunity zone 7, not the one that you just saw, but this one just broke ground. One of the things I love about Capital Square too is they've got construction cameras. for all of their projects, as well as if you want to go back and look at OZ 1, 2, 3, or 5, they've got time lapses. So, you know, I'm going to turn it back to you, Tim. Talk a little bit about opportunity zones.
Okay, let me get through this pretty quick because I don't want people nodding off on us. Here's the thing about opportunity zones. They were designed to redirect private capital to areas that needed an infusion of that capital to improve. It's part of the 2017 Tax Cut and Jobs Act. That said, let me tell you why it's better than it sounds. Opportunity, and what I'll do is I'm just gonna give a quick snippet of a 30,000-foot view of what smart money does with op zones, and then I'll dive into some of a little bit more granular, Judd, but I'll make it in comparison with 1031 so we can anchor it down a little bit, okay?
Perfect.
Okay, so I'm just gonna speak as an investor. And because Judd's an investor, by the way, guys, I've invested in op zone 3, 5, the one you just saw in that video, 6, which is in Raleigh, North Carolina, awesome real estate, and 8, and I have not done 7 yet because 7 is right next to 5, and I just figured I've already got some real estate in the same area. But guys, if you get on our website and you go look at our opportunity zones, you're going to find that they are in phenomenal locations. Now, what did I just tell you? I just told you opportunity zones was designed to invest in basically underprivileged areas. But the data is based on the 2010 census, which means a lot can happen in 13 years. And a lot of areas have been gentrified over that period of time, but we still get the opportunity zone effects, if you will. So we're not investing in bad areas. I don't want to leave you with that impression. These are great areas. They've already been gentrified. We've mitigated whatever location risk that would come along with investing in underprivileged areas. And so we start off way ahead of the game. We start off with the deck stacked in our favor, but we still get the tax benefits with an OZ.
Yeah, Tim,
I'll tell you right now, as far as comparing opportunity zones with 1031s, a 1031 is limited to real property for capital gains. An opportunity zone, you can take any kind of capital gain, whether it's Bitcoin, art, cars, stock, mutual funds, whatever. We're not hampered by just real estate capital gains. It's any kind of short-term or long-term capital gain, regardless of what asset generated it. That is a big deal. I'll say another thing. For a 1031 exchange, you have to, if you want the full benefit of a 1031, you have to buy a property that's equal to or greater than the property that you sold and spend all your cash. Well, that's not true for an opportunity zone. If you want, you only reinvest the capital gain. You can take your basis in the real estate and do whatever you want to with it. Go to Vegas, go on vacation, reinvest it in another development deal, which would be the smart move. But all you really have to do to get the tax benefits is invest the capital gain. With a 1031, you need a qualified intermediary. You need to identify whatever real estate you're going to invest in within 45 days, and you need to buy it within 180. And those are not consecutive; they're concurrent. And with an opportunity zone, there is no 45 day. There is no QI. All you need to do is reinvest your proceeds within 180 days. So what that means, guys, if you sold something 4.5 months ago and you forgot to do a 1031, we can go back and save that for you, or Judd and Craig can. If they like a certain opportunity zone, they can go find that and reinvest it for you, and then you don't pay taxes on the capital gain. What else can I tell you? One of the things that we just touched on, and I'll just say this: with a 1031, you can invest in any kind of real estate. With an opportunity zone, when you're doing opportunities, you invest in an opportunity zone. We covered that just a little bit, but that is a restriction that you still have to deal with. No qualified intermediary. I'll shut up on this. Everybody goes, well, it's a 10-year hold. That's a long time. And they're absolutely right. It is a 10-year hold, and that is a long time. But if you think about it in context with, let's just say, a 1031, and instead of Jake being 75 years old, Jake is 60 years old. Okay. Jake's a smart man. Jake is going to continue to do 1031s until he passes away. Judd, what does the insurance company tell you? How long is Jake going to live?
Average is what, 85 these days? Something like that?
85, 86, something like that. So Jake's going to be doing 1031s for the next 26 years. And to get the full benefit of a 1031, he's got to be dead. I mean, let's be honest. He'll be dead. And at least with an opportunity zone, it's only 10 years long, and he'll be alive to reap the benefits of having, a great financial advisor like Judd and a good CPA.
And you can walk, Tim, you walk away. At the end of 10 years, I can take my money and do what the hell I want to it. I ain't got to keep on, swap till I drop. My money, as Craig likes to say, it's a Roth IRA on steroids with no cap as how much I can put into it, so to speak.
Now, Tim, the only thing that we don't know, okay, because OZs have just started in 2018. We have, obviously, the OZ's Cap Squares doing it is with apartment complex. When that 10-year mark comes, obviously the market for real estate may be up, it may be down. Obviously, you're not going to, Cap Square would not look at selling if it's down, but what projection, the problem is we have no history. What projection do you think the OZ is going to look to go for?
Great question. Judd, why don't you, I don't know if we planned this or not, but that's a good segue. Why don't you move over to Op Zone 8? And Craig, I'll give a quick 30-second overview maybe, and then dig into what your question is, okay? So we can add a little color for everybody. So this is in Knoxville, Tennessee. This is the point I guess I'm trying to make, that it's all about getting good real estate first. This is in Knoxville, Tennessee, waterfront property, directly across from Neyland Stadium. You know what, Judd, can you flick forward? I don't want to be redundant. Okay, well, here's the offering overview, and then I'll talk about some of the basics. Minimum of 100 grand. There's an 8% preferred, which I'll get to when I answer Craig's question. But sort of focus down there. It's 348 units. Knoxville, Tennessee, expected to be completed Q3 2024. Okay, let's stop right there. We've already broken ground. Construction has begun. That is a big deal. Judd, is there a map on the next page? Well, okay. I'll just stop. I'll just go into that then, and then I'm going to tackle Craig's question, and we'll be done. We already done all the rest of that stuff. I guess I skipped ahead a little bit. But guys, if you ever want to see good real estate in an opportunity zone, this is it. Like I said, waterfront property. Directly next door, they've got condos going up for $650,000 a piece. From our property in its current state, you can see downtown Knoxville. You can see Neyland Stadium and the basketball arena and the campus of UT. There's marina right next to us. But what I'd like to touch on that's kind of most important is it's got unbelievable support from the city of Knoxville. They've given us a $6.5 million grant on top of the fact that the returns will be tax-free. And they've allocated enough funds for a pedestrian bridge that goes from the south end of our property to the south end of Neyland Stadium. And so this is what I mean by, guys, you can get your cake and eat it too, because we're going to get the tax benefits from this. But we're also going to get great real estate. And so let me touch on the preferred real quick. Judd, can you scroll up just a smidge? Right there. So what we're saying here is this thing is gonna have an 8% preferred, compounding starting year one. And then our goal is to sell this thing. And when we do, you're number one, you'll get your money back. Priority number one. Number two, you get an 8% preferred. And over the 8%, when the 8% is paid out, then this is how we make money. You guys need to understand this. This is how we make money. We're going to split the profits, and that'll be 80% to the investor and 20% to Capital Square after the 8% preferred. That's important. So to finalize all this and wrap it up a little bit, Craig asked what we anticipate for the returns. We're expecting, because it is a development deal, guys. So the returns are going to be expected to be a little bit higher because it is a development deal. We're expecting an internal rate of return or a return on investment of about 16.27% per annum. And if you wanted to simplify that, we're looking at basically a 2.4 multiple. So if you put $1 million in, we're expecting roughly about giving you 2.5 million back. Simple as I can put it.
Well, that's impressive.
Yeah.
I
Well, it's
wanna
great real
mention
estate.
something
I couldn't
too.
sit up here and talk about all kinds of real estate, but I can about that one, and it's a good spot.
So a couple of things I want to mention here, Tim, is one of the things that I love about this one. Mine was a 7% pref. Okay. This is an 8. But you have an immediate audience for some of these 348 units. Do you not, Tim? I believe 40 of them or something of that nature has to be faculty and or staff. And that's almost like a subsidy in itself, right?
Well, it's 35 units, correct.
Okay,
35,
so 10,
because they're
10%.
giving us a TIF grant, which is $6.5 million up front, which is awesome. We have set aside 35 units for workforce housing. What I did not mention, Judd, I probably should have. The return numbers that I gave you, purely estimates, do not factor in the fact that after 10 years, that workforce housing goes to market housing, and your NOI will jump dramatically, and then we will sell the thing and return the investors money, and they will have made X amount of dollars. Let's just say it's a 2.4 multiple, and that multiple would be tax-free.
That's the key. It's tax-free. 100,000 in, 240,000 out. At 240, you walk away with it. It's yours. If you want to go to Vegas and blow the whole thing, IRS can't touch it.
Right.
And one other thing that I almost am a little bit hesitant to mention here is that we're not mitigating your capital gains. We're not eliminating it, I should say. We're mitigating it. And what that means is that currently the legislation has changed a little bit. We thought it was going to be owed in 26, right, Craig?
Well, Tim and I are going to discuss that afterwards.
Okay.
So we're going to discuss
anyway,
that one afterwards.
If-
What they need to know is we're kicking the can down the road on their capital gains. They're still going to have to pay capital gains on their initial investment. There is some pending legislation that may or may not help them. So the 100,000, again, I keep on going back to 100,000 because it's easy to do the math. 100,000 eventually is going to get taxed, and it could be as late as 2028. But the gain from that 100,000 to 240 will that's the part that is tax free.
Okay. So Craig and Tim, I have done a decent amount of business with Capital Square. Tim and his crew offered to take me and my business partner on my Tennessee project just individually up to Capital Square. They, for some reason, like me. I'm not sure, but nevertheless, they have offered me a lower minimum. You see here, it does say 100,000. They have offered my clients as little as 25K. I have to ask for an exception, but they've given it to me always. The second thing that I want to be hesitant to mention, but I'm going to go ahead and mention it anyway. The goal of Capital Square, as well as other opportunity zone companies that I work with, and there are a decent amount, okay? In that third to fourth year, when they stabilize this property, in other words, they get it up to lease, or get it built out, I should say, they're going to actually do kind of what I would call a refi and cash out. Okay, not guaranteed. I want to repeat that. What did I say, Craig?
It is not guaranteed.
It is not guaranteed.
However, go ahead, Judd. Go ahead and finish.
However, they have done it even before we thought they would in Capital Square, because these guys are phenomenal at what they do. And they are kicking out somewhere between 20 and 50% of your original investment that, one, is not taxable, two, does not lower your basis, so to speak. And so what is that for, folks? That's for you to pay your capital gains. And there might be more than what you need. So again, do what you want with the other part. Not guaranteed, but they have done it.
Correct.
So anyway,
All good.
That's what we got for you. We on purpose did not have questions here because we want you to come to me and Craig to talk about this. One, Craig to run a tax planner. Two, he will then tell you, all right, I'm not securities licensed. Judd is the person that you'll need to do this through. Maybe you have a financial advisor and they can do alternative vehicles. Great. You know, there's tons of business around. Talk to them about it. But if they don't, and a lot do not, please, we are taking new clients at JHG Financial. We are running about 7 minutes late. I apologize, but I want to thank you for attending tonight. And I want to thank those of you that done business with me and Craig. And above all else, thanks for putting that trust into our hands. Anything, Craig, on your end?
I appreciate everyone that joined, and actually thank you, Tim, for coming on board tonight and giving us your expertise, knowledge. And if you will actually do me a favor, is there a way you and I can talk?
Yeah.
I need to talk to you just 2 minutes.
Yeah. You want to just call me?
I'll call you.
I will forward on his contact to you, Craig.
Thanks, Judd.
All right, everyone, y'all have a great evening. Happy Thanksgiving.
Bye-bye.
Bye-bye.